Energy, we got our production cut. OPEC Plus surprises with an extra 500,000 barrel a day cut, prompting a rare sustainable rally of about $7. We're over $60 down the price of oil. Saudi Aramco deal finally gets done after 3 years in the process. One of the largest IPOs in history, immediately traded to a 20% premium because every global index fund in the world had to buy it in order to index. You can't run a global index company and not own the largest company in the world. So that was an artificial pop that was designed to happen. Most global index funds are forced to buy it. Most hedge funds are trying to figure out how to sell it short. Oversupply against fading demand will last for years. Energy shares are rallying, but few are convinced it's sustainable. Avoid all energy plays like the plague. Don't convince gone down a lot with cheap. And by the way, a lot of the energy sector has absolutely massive debt. A lot of these limited partnerships, master limited partnerships, which are offering 7, 8, 9% yields, also are leveraged to the hilt, and any rise in interest rates will wipe them out. And that's exactly what we saw happen in 08, 09. So oil, yep, $60.87, grinding up. I was negative on this. Fortunately, I didn't trade off of that. I didn't trade on it because stuff going on in stocks was just so much better. Okay, let's see. Let me look for more questions here. Okay. Back in August, here's a question from Kay. Back in August, global economy looked to be stalling, yet it was a great time to buy stocks. That is, when you buy stocks is when the economy looks terrible. If you get used to buying on the bad news and selling on good news, you will do very well as a trader. Most people do the opposite. People were dumping stocks in August, and that, of course, is when we went with one of our rare 100% longs. Also asking is, do you see a global slowdown during the melt up? Well, the economy is still slowing down. It never stopped slowing down. We're probably looking at a 1.5% GDP this quarter, but in liquidity driven markets, you don't look at fundamentals. That is available to buy equities. That's why you buy equities. That said, if we ever do get a real economic recovery, you might actually have stocks get down because PE multiple 20, not a great place to buy stocks. Okay, Peter is asking, what do you prefer for a VIX trade? An option on the VXX. That's one of them. You can do call options on the VXX, which is an ETF. If you have the facility to trade futures, then options on the futures in the VIX is how most professionals will trade that. Another question from Steven, should we be worried about the repo crisis as we approach the end of the quarter? Absolutely, you should be worried. The Fed may have to come with another round of quantitative easing in order to prevent a surprise overnight pop in interest rates to 5%. That's what happened last quarter. Could happen again. And the basic problem is that the structure of the US debt markets aren't built to handle the volume of borrowing that's coming through from the US government. So with debt at all-time high, we're kind of in new territory here with whether markets actually can handle that amount of borrowing. Total government borrowing next year will probably be $1.5 to $1.75 trillion. Okay. Okay. Let's move on here to the rest of the oil story. There's the USO multi-month high. Energy Select, top of the range, but that's it. Getting resistance at the 200-day moving average. Halliburton breakout there. Why you would buy this, I have no idea, because this is one of the most expensive stocks out there. Nat gas collapses going into the winter, testifies to the oversupply of energy that's out there. I hope all of you found this helpful, and hopefully it has also improved your trading. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.